All right, let's dive into one of the wildest, most high-stakes bets in modern finance, MicroStrategy's journey to becoming essentially a Bitcoin holding company. They've piled up an absolutely mind-boggling amount of Bitcoin. So the big question is, can they actually survive a crash? Is their fortress truly unbreakable?
To really get a sense of just how big this is, just look at this number. Our analysis projects that by late 2025, MicroStrategy could be sitting on 650,000 Bitcoin. That's more than 3% of all the Bitcoin that will ever exist. I mean, we're not just talking about a corporate savings account here. This is a hoard so big, it could potentially move the entire market.
Now, you'd think with that much on the line, they'd be a little nervous. But nope, management has been famously, almost absurdly confident, making statements just like this one. They're convinced they have built a financial structure that is completely immune to a catastrophic forced sale. You know, the exact kind of thing that would normally vaporize a company using this much leverage.
But is it really true? Can they really not blow up? Well, that's exactly what we're here to figure out. We're going to put their entire financial structure through the ringer, the ultimate stress test. We're going to simulate what happens if the Bitcoin price drops, from a little 5% dip all the way down to an apocalyptic 90% crash. Let's see if this machine actually holds up.
Okay, first things first. We need to get our heads around how their value creation engine is even supposed to work. It's often called the Saylor flywheel, and in theory, it's designed to be a kind of perpetual motion machine for stacking up more and more Bitcoin.
So here's the magic trick. It all hangs on one thing. The stock has to be trading at a premium. That just means the market values the company for more than the Bitcoin it's actually holding. When that happens, that's step one, the company goes, great, and issues new shares at that higher price. Step two. Then, step three, they take all that new cash and immediately use it to buy more Bitcoin. And here's the clever part. Step four. Even though there are now more shares out there, the amount of Bitcoin per share actually goes up. It's a sweet little arbitrage loop that rewards the people who already own the stock. But, and this is key, it only works as long as that premium is there.
But what happens when the music stops? What happens when the market goes into a free fall? Well, this is where the company's defensive strategy comes in. They've built a very specific financial shield to protect that flywheel. Let's take a look at how they put it together.
Okay, this slide is absolutely crucial. It's all about their debt. You see, they used to have secured debt. That's the super risky kind, where your Bitcoin is the collateral. If the price of Bitcoin drops too low, your lenders get nervous and they can force you to sell your Bitcoin to pay them back. It's the classic, dreaded margin call. But look at the new reality. They've brilliantly shifted almost entirely to unsecured debt. There's no collateral. There are no covenants about the loan-to-value ratio. A Bitcoin price crash simply does not trigger a forced sale. This right here is their main line of defense.
But, and this is a huge but, that shield came at a steep price. They swapped out that risky debt for really expensive preferred stock. And this chart just lays it all out there. Their annual interest on their actual debt is a measly $27 million bucks. Peanuts. But their annual dividend payment on that new preferred stock, a jaw-dropping $780 million. So they basically traded the risk of a sudden death by margin call for the risk of a slow, painful bleed-out.
All right, so we get it. We know how the machine works, and we know how the shield is built. So now, let's start the stress test. We're going to break this down into 4 stages, or let's call them tranches of pain, starting with just your everyday market shot.
So in this first tranche, let's say a drop of anywhere from 5 to 20%, honestly, the company is totally fine. There's zero risk to their solvency. The only thing that really happens is that the flywheel, that perpetual motion machine, it just starts to spin a little slower because the stock's premium starts to shrink. The growth engine is still running, it's just not quite as powerful.
Okay, now things get interesting. In a real bear market, we hit the first major failure point, not for the company's survival, but for its strategy. When Bitcoin drops 25 to 45%, that premium that powers the whole machine just evaporates. At a 25% drop, the flywheel completely stalls. And if the price keeps falling, the stock actually starts trading at a discount. At that point, issuing new stock to buy Bitcoin would literally destroy value for shareholders, so they have no choice. The machine gets turned off.
And just like that, the growth machine is officially offline. The whole company is forced to pivot. They have to stop playing offense, so no more buying Bitcoin with newly printed stock. And they switch to pure defense, hunkering down and relying on their massive, recently raised $1.44 billion cash reserve to ride out the storm.
Now we're entering a real, full-blown crash scenario. In a 50 to 70% drop, that leverage they're using starts to become incredibly painful. The value of the common stock just gets hammered. It's eroding rapidly. The market starts to get really spooked, wondering if the company can even keep up with those massive dividend payments, which just puts even more pressure on the stock. Things are getting bad fast.
And that brings us to the final, most extreme part of our test. We are now entering the point where the company's assets are actually worth less than what it owes. We are in the insolvency zone.
Just look at these numbers for a second. At a 75% drop, which puts Bitcoin around 21 grand, the company becomes what's called balance sheet insolvent. Its liabilities are now greater than its assets. If it gets to a 90% drop, down to about $8,500 for a Bitcoin, the value of all their Bitcoin is less than even the principal they owe on their debt. The common stock has been completely and totally wiped out.
So, there it is. On paper, by every technical definition, they are now insolvent. For pretty much any other company, this would be game over.
But they are not bankrupt. And this, right here, is the most mind-bending part of their entire structure. How is it even possible to be insolvent but not bankrupt?
Well, they enter what our source material calls a zombie state. Think about that. A company that is technically worthless, its equity completely gone, but it can still pay its bills. It's just shambling along in this kind of financial purgatory, avoiding a legal bankruptcy because there's nothing to actually trigger one. So how on earth do they pull this off? Well, it boils down to three really important things. First, that huge cash reserve of $1.44 billion easily covers their tiny $27 million annual interest payment, so no default. Second, as we said, the unsecured debt has no margin call triggers. No one can force them to sell. And third, Michael Saylor has voting control, which means no activist investor can come in and force a liquidation. They can just keep going. But here's the catch. Surviving as a financial zombie, that's not a permanent solution. That whole "we cannot blow up" claim, it has an expiration date. There's a real ticking clock, and it has nothing to do with the price of Bitcoin on any given day.
This timeline shows the real threat. The company can absolutely survive in its zombie state through 2026 and into 2027, but all the while, it's draining that cash reserve to pay those massive dividends. But then we get to 2028. The clock runs out, and specifically, on September 15, 2028, a gigantic $1.01 billion debt payment comes due.
And on that date, there's no more financial engineering, no more tricks. If Bitcoin's price hasn't recovered by then, they won't be able to refinance that debt. They will be forced to come up with over $1 billion in cold, hard cash. And if their reserve is gone, that means they have to do the one thing this entire elaborate strategy was designed to avoid: selling their Bitcoin into a crashed market. That is the real blow-up moment.
So, what's the final verdict from our stress test? Well, MicroStrategy has built a structure that is incredibly resilient to a price crash. They made a fascinating trade-off. They got rid of the sudden, catastrophic risk of a margin call, but in its place, they accepted a slow financial bleed from those dividends and a hard, non-negotiable deadline in 2028. In a really bad crash, they don't die. They just become a zombie, waiting and hoping for a market recovery that might not come in time.
Which leaves us with one final big question. Is this some kind of next-level, sophisticated financial engineering that has actually figured out how to tame volatility? Or is it all just a really clever, high-stakes gamble that kicks the can down the road, praying the market saves them before that final clock runs out? I'll let you be the judge of that. Thanks for tuning in.